Good afternoon, everybody. We will be starting soon. Let's just give a few minutes for others to join. Okay, can you guys hear me? Okay, thank you so much. We're going to be covering the practical question today on borrowing costs. So this was the question that was on ULink. This is the question that you need to do. We're going to get started with it now. Before we actually start with the question, I just want to recap some principles from borrowing costs. So in second year and in first year, when you came across borrowing costs or interest, remember that another term for borrowing costs is interest. Okay, normally we would just expense interest. Okay, that would be where all that you've learned in second year and in first year. So whenever we needed to pay interest, we would just do a journal entry to expense it, and that journal entry would be to debit interest expense and credit bank if we've paid the interest. If not, we would credit our liability. Okay, this year we've gone one step further, and we're saying that borrowing costs will be expensed, or interest will be expensed most of the time, but in certain instances it can be capitalized. And when we say capitalized, actually what we're saying is that it is added to the asset or the cost of the asset. That's what we mean when we say borrowing costs can be capitalized. So it will only work when you have a qualifying asset. And a qualifying asset most of the time would be your PPE items or your intangible assets. So if you are busy obtaining or constructing an asset and you need funding or you need money to buy that asset or to construct that asset, then you need to get funding or loans. And the interest that you pay on that loan, you can then add to the cost of your asset. So that's how we are allowed sometimes to capitalize or add to the cost of the asset our interest. Okay, and this is what we are covering now. Does that make sense to everybody? Okay, I think that is very important that you understand this concept here, because this is where students struggle a lot. They don't understand that interest sometimes can be capitalized. Okay, so instead of saying debit or interest expense, credit bank, we would debit the asset and credit bank. But there's certain rules that we need to follow in order to make this work. Okay, and the first thing that you should do, okay, the rules that you've learned is what is a qualifying asset, when should you start capitalizing, when should you stop capitalizing, when should borrowing costs be, when should capitalization be suspended. All of that is a theory which you would have covered in the class. But when you're looking at any question, the first question that you should ask yourself, okay, in a borrowing cost question, or the first thing that you should do, so the first thing, number one, is you need to determine what type of borrowings is it. Okay, so you would have learned two types of borrowings. You would have learned that there is specific borrowings And what is the other one? Does anyone remember from the theory class? General, good. So the other one is general borrowings. Okay. Now, in order to determine if you're reading a question, whether it is specific or general, you need to understand what each type or what does specific and general borrowing mean. Okay, so does anyone want to try and explain to me what is specific and general borrowings? And then I will explain it thereafter. Nobody wants to try? Let's see. Yes, okay, so specific is taken out specifically to fund a qualifying asset. Okay, in other words, with specific borrowings, that is a good answer. With specific borrowings, basically, you know what you are doing. You want to construct this asset. You need a loan for that asset. So you would go to the bank or whoever else and say, listen, I want to construct this asset. It's going to cost me 1 million rand, and I need 1 million rand to construct that asset. That's it. So you're taking out a loan specifically or only for the reason of constructing that asset. Okay, so it's specific to that project. It's for that project alone. That's what specific borrowings mean. Okay. Okay, so thank you for trying and for answering. It's a loan for a specific project. That's right. Then general is for general purposes in the business. Okay, that's also correct. So general borrowings, on the other hand, is when you don't have that loan specific for that asset, but if you just have funding available. So normally, if you go to the bank and you say, listen, I am busy with a few things. I'm constructing this asset, but I also need money to pay some overheads like salaries and all of that. So can you please help me out with a loan? So you are going, it's a general borrowing. You are using it for a few different things and not specifically only for the construction of that asset. So that is general borrowings. So you have to classify or know the difference between the two. As you're reading through the information in the question, you can identify for each loan. And remember that in a question, it can either be specific borrowings, it can either be general borrowings, or it could even be both of them, because there is sometimes more than one loan which we are referring to. Okay, so for each and every single loan that you have, you're going to determine, is it a specific borrowing or is it a general borrowing? So don't just assume that the whole question is just specific or the whole question is just general. You need to determine for each loan whether it's a specific loan or a general loan. So that's what you need to do. Okay. Also, sometimes, and this was mentioned in the slides as well, people just assume that an overdraft facility is general borrowings. Okay, that is not always the case. Overdraft can be specific or general depending on our rationale or our reasoning we said now. If the overdraft is used specifically for that project, then it would be specific borrowings. And if the overdraft is used for lots of different reasons for general purposes, then it would be general borrowings. Is there any questions on that? Do you all understand that? Okay, perfect. Okay. Okay, so now what we're going to do is we're going to read through this question here, and we're going to determine whether it's specific or general borrowings for each and every loan that we discuss. Okay, so just going to the required quickly before we go to the question. If you look at the required, okay, the first question or 1.1 says, when will the capitalization of borrowing costs not be suspended? So that is just a theory question which comes from your slides. I'm not going to go through that. If you go through your slides, you will see the answer to that there. Basically, it will not be suspended if it's just a temporary delay in time. Okay, so if you delay the project for just a temporary period or because of admin issues or something like that, then you should not suspend your borrowing costs, capitalization. Okay, then 1.2 says calculate the capitalization rate of the new factory, and then 1.3 is to calculate the amount of borrowing costs to be capitalized. Okay, so just looking at 1.2, 1.2 says we must calculate a capitalization rate. That kind of gives us a clue. What clue does it give us? When do we normally calculate a capitalization rate? Okay, yes. So normally, if we do in general borrowings, we will need to calculate a capitalization rate. So this is a clue to us that there is probably some general borrowings in this question. So let's go to the question and continue. Okay, so it says that Mike Ross Limited is in the construction industry and has a December reporting period. On the 1st of January 2015, the entity commenced with the construction of a new factory. The construction will be financed with a general 13% loan of 5 million obtained from Finance Bank and a bank overdraft of 5 million rand. The interest payable on the bank overdraft is 15%. Both funds are available from the 1st of January 2015 and nothing was repaid during the year. On the 1st of December, the company decided to take out a specific loan of 2 million to utilize towards the completion of the factory, as the general borrowings have been withdrawn from this project and used for other operations. Interest on the special loan is 9%. Okay, so in the question, and then they give us the amount that was the contractors as well. Okay, so just looking at the question, there's also other clues which help us to identify whether it's specific or general. But before we do that, I want us to number the number of loans that we have, because for each loan, we need to determine the type of borrowings we have. Okay, so who can tell me which is the first loan here? Okay, it's this one here. The general 13% loan. So that is the first loan that we have. Are you all happy with that? That's number one. And then we have the second one, which is the bank overdraft of 5 million rand. So that would be number 2. Okay. And then what is the third loan in this question? Okay, the special loan or the specific loan of 2 million rand. So the special loan here of 2 million rand. Good. Okay, so that is number 3. So in this question, we have 3 loans. Now we need to determine for each loan that we have, 1, 2, and 3, which ones are specific and which ones are general. So starting with number 1, okay, they also kind of gave us a clue. They said to us that they're calling it a general 13% loan. So obviously, this would indicate to us that this is part of general borrowings. Okay. Good. Okay, then what about number 2? Why do you think that is? It is also general because if we read again, the construction is financed with a 13% general loan obtained from the bank and a 5% a bank overdraft of 5 million rand. Further in the question, they also say that the general borrowings were withdrawn from the project. So both 1 and 2 are general borrowings. Okay, so general is yellow, this is yellow, and that is yellow. So the 2 loans that are general borrowings are the ones in yellow, number 1 and 2. Okay, and then the third loan we have, what do you think that is? Do you think it's specific or general? Okay, it's specific because they say that the company decided to take out this loan to utilize towards completion of the factory. Okay, so we're using it for completion of this project. We are not using it for anything else. So this last loan here, okay, is gonna be specific borrowing. So that's what I was saying earlier, that in a question, okay, it doesn't mean that the whole question can just be specific or general. Sometimes it might happen. You might also have a combination of the two. So in this question here, there is specific and there is general borrowings. Okay. So when we answer in 1.2 to calculate the capitalization rate, what do we focus on here? Which loans do we focus on here? Remember, the capitalization rate is only applicable to what? It's only applicable to general borrowings, correct? So we need to focus only on the loans which have general borrowings, okay? And that would be number 1 and 2, the 13% loan and the bank overdraft, okay? So how do we calculate a capitalization rate? Let me just change my color. Okay, so when you calculate a capitalization rate, remember that you need to determine basically like what is the average interest rate of the 2 loans or 3 loans or whatever it might be. In this case, it's 2 loans. So we start off by working out the interest for each loan. So we have 2 loans, okay? The first is the 5 million rand loan. Okay, and that one, the 5 million general loan, and that one is interest rate of 13%. So we're going to multiply that by 13%. Okay, and then our second loan is the overdraft, which is also 5 million. Okay, I apologize for my handwriting. It's just difficult to type when it's so zoomed in. But if I zoom out, then you won't be able to see. Okay, so the interest overdraft has an interest rate of 15%. Do you all follow where I get the amounts from and the percentages from? Good. Okay, so I'm going to do that calculation. Okay, remember the question is that no repayments were made during the year, so interest is applicable for the entire year. Okay, and it was the loans were taken out on the 1st of January, so we're going to calculate interest for the whole year. So the first one, it will be 650,000. Okay, and the second one will be 750,000. Okay, so that's our first step to calculate the interest. When we add this together, we get 1.4 million. Okay, then the next step is then to add the 2 loans together. So the 2 loans together, we're going to add them. It's 5 million and 5 million. And that's going to give us 10 million. And then to calculate the capitalization rate, what you would do is you would take your interest of 1.4 million here. So you would take your interest of 1.4 million and you would divide it by the 10 million. So you take your total interest divided by your total loans that you obtain, and that will give you, and then obviously you multiply it by 100, and that will give you your rate. In this case, the rate is 14%. Okay, so this was quite a simple calculation. Okay, and if you did all of that, you would have gotten the 6 marks that are allocated there. Okay, so I think that what you need to do is firstly, if you determine which of the loans are general, then it's quite easy to calculate the capitalization rate. Okay, you just take your interest, your total interest divided by your total borrowings. If for some reason you get one of the interests wrong or whatever, you're still going to get part marks. So please show your workings, show how did you get to that capitalization rate. So don't just put down an answer, you need to show how did you calculate it, how you first calculated the interest, and then you took the interest divided by your total general borrowings. Any questions? Okay, so I'm going to repeat that. Okay, when we're calculating a capitalization rate, okay, remember that a capitalization rate is only applicable to general borrowings. So the first thing that we did in this question here is we went to each loan and we said for each loan what type of borrowings it is. So we determined that the first two loans, the general 13% loan and the bank overdraft, those are general borrowings. So when we're doing our calculation of the capitalization rate, those two is what we will use to calculate the capitalization rate. When we calculate the capitalization rate, the formula which you learned in the theory class is that you need to first calculate your interest for each general loan. So we take the loan amount multiplied by the interest rate and for each one, and that will give us a total interest of 1.4 million for both these general loans. You then take that interest or the total interest divided by your total loan amount, which is just basically the two loans added together, and that multiply that by 100, and that will give you your capitalization rate. How would we account for the capitalization rate if there were deduction payments made during the year? Okay, if there were deduction of payments made during the year, then remember when it's going to affect your year when you're calculating your interest. If, for example, halfway during the year we paid 2.5 million of the loan, then you would have an interest calculation where you would have 5 million times 13% for 6 months. And then for the other 6 months, because you paid back half the loan of 2.5 million, you would only calculate interest on 2.5 million times 13% for the other 6 months. So it will impact your, when you are calculating your interest year, that's when it will impact your capitalization rate calculation. Okay, so that's if there is any repayments during the year. Does that answer your question? Is there any other questions? Do you all understand the calculation of the capitalization rate? Okay, good. Okay, then we're going to move on to 1.3. 1.3 says we need to calculate the amount of borrowing costs to be capitalized for the reporting period ended 31st December 2015. Okay, so here when we want to calculate how much of the borrowing costs will be capitalized, here we're going to consider all of the loans because all of the loans, the general as well as the specific loans, all of them have been used for this project, and we're going to see how much should be capitalized for each one. So because we started off here with general borrowings, we're going to start off with the calculation of how much of interest to be capitalized for the general borrowings as well. Okay, so when we did in the slides, if you can recall, okay, whenever you calculated a capitalization rate, what did you then do with that capitalization rate in order to calculate how much of interest should be capitalized? Does anyone remember? Okay, speak. Principal Hela.
Good evening, ma'am.
Sorry. You can continue.
Yes, my question is related to 1.2, if there was a repayment. What I want to know is, when we divide, do we still divide by the 10 million or by 7.5 million, since there was a repayment of 2.5 million?
So you need to divide it by the number of the borrowing, so you would weight it. I haven't seen a question like this for your guys' syllabus. So what you would do is that you would say 5 million for 6 months and then 2.5 million for 6 months. So it would be a bit of a longer calculation. You would say 5 million times 6/12 and get the loan amount for the 6 months. And then you would say 5 million times, 2.5 million times 6 months, so it's times 6/12. And then you would add those two together, and that would be for the 13% loan. And then you would add that to the 5 million, and that would give you the total borrowing for the year. So you'd also weight it for the months, if that makes sense. Does that make sense?
Yes, ma'am. Thank you.
Okay. Okay. So going back to 1.3. So yes, when we have general borrowings, when we calculate the capitalization rate, what we then need to do, as you guys are saying, we need to multiply it with the payments. Okay. So the payments have been given to us, and it will be given to you in a question. So here's the payments given here. Okay, it says that on the 31st of March, 300,000 was paid to the contractors, and a further 1 million was paid on 31st of July. These dates here are important. Okay, what's important about these dates here is it's going to help you to count for the number of months. And the way that you would count for the months, this is important. Please pay attention to this. You always count from the date the payment was made until the year end, or if something happened where the project stopped, or the loans were taken away or something like that, then you would stop at that date. So always count from the date the payment was made to either the year end, or if something else happened before that, to that date. Okay, so what am I saying? You would count if, for example, this first payment year of 300,000 was on 31st of March 2015. Okay, so we would count from April, because 31st of March is the end of March. So we would count from April until either the year end. In this case, the year end is 31st of December. But if something happened before that, we would stop before that. So in this question, did something happen before that? Did the project stop, or did something happen that will make us think that maybe we shouldn't go to the year end? Yes. Okay, what happened? Okay, this was one of the past questions from one of the years, and this year a lot of students missed. So what happened was that on the 1st of December, the company decided to take out that special loan, and because the general borrowings have been withdrawn from the project, so we cannot count until the end of the year. We have to count until the 1st of December, because on that date is when the general borrowings have been withdrawn. So those loans are no longer going to be used for that project. It's now taken away. So it's not related to that project anymore. So it would be incorrect for us to still capitalize until 31st of December. Okay, so therefore, our cutoff date is the 1st of December. Does everyone understand why the cutoff date is the 1st of December? I'm going to explain it one more time. Okay, so because on the 1st of December, the company decided that the general loans are no longer going to be used for this project, therefore, we cannot capitalize after that date. If it's no longer used, we stop capitalizing. Okay, so we're going to count until the 1st of December. So if we quickly count the months, for the first payment of 300,000, we're going to count April until November. So it's going to be April, May, June, July, August, September, October, November, and that would be 8 months. Okay, does everyone know how to get 8 months here? Okay, so let's count again. So we're going to count from the date the payment was made. That's what you would do. So you would count from the 31st of March, or in other words, from April. You would say April, May, June, July, August, September, October, November. Okay, so basically, let's quickly do a timeline. That's a good idea. So we're going to count from April until December. Okay, so this would be from the 1st of April until the 1st of December. So if we count the number of months here, it would be 8 months. Okay, if we look at the full timeline, okay, our year starts on the 1st of January and it would end on 31st of December. Okay, but we only count in what's in red because that is the only time that we use that general loan. So we would have used the first 300,000 on the 1st of April when we made that first payment. So you would count for the full month of April, May, June, July, August, September, October, November, and you don't count December because the general loan was taken out on the 1st of December. Can you see there? On the 1st of December. Okay, so this year is the 1st of December. So we stop at that date. So we only count until November. Okay, December, that month, we took it out from the project. So that's why it's 8 months. Do you all understand how we get 8 months? So you wouldn't count the month of December. Okay. Then if we look at the next payment was the 1 million rand that was paid on the 31st of July 2015. Okay, so we're going to count from that date, from the 31st of July until what date? Until the 1st of December. Okay, and how many months would that be? That would be August, September, October, November, and that would be 4 months. Good. Okay. Okay, so that's how we get the months. So what you need to do is you need to take those expenses, the 300,000, multiply by your capitalization rate of 14%, and then multiply that by the number of months. And that would be the first one, 8/12. For the second one, you would take the 1 million multiplied by your capitalization rate of 14%, and then multiply that by 4/12. Okay, then are we done? What did we not do here? We didn't take into account something, that is the specific loan. Okay, so I'm going to repeat that calculation just now. Okay, the only problem is I have no place to write it out here, and if I go out of this, all of these workings are going to go away. Okay, so let's quickly explain it again, and then I'm going to go to the solution, and then I'll explain it for the third time as well. Okay, so the first thing in this question, we identified that there was 3 loans, and 2 of these loans were general. So the ones in yellow here, the 13% general loan and the bank overdraft, those were general. And then there was one specific loan, and that was this third loan year of 2 million rand. So the first thing for the general loans, we needed to calculate a capitalization rate, and we did that by taking the interest on those two loans, the total of the interest divided by the total loans, and that gave us 14%. What you then need to do with that capitalization rate that you calculate, you need to multiply it by your expenditure and by the number of months that you have used it for. Okay, so like just how you do a portioning for PPE, you would do the same thing here. Okay, so in order to do that, let me see if I can write it here. You would say that first payment, okay, of 300,000 multiply by your capitalization rate. Remember, we calculated the capitalization rate here, 14%. And then I would multiply it by the number of months that I used it for. And that, remember, we counted from the 1st of April until the 1st of December, and we said that was 8 months. So you would multiply that by 8 over 12. Okay. And then the next one was the payment of 1 million. So you're going to take the 1 million, multiply again by your capitalization rate, which is the 14%. And then we're going to multiply it by the number of months, which we worked out here from when the payment was made, 31st of July, until the 1st of December when the loans were taken out from this project. And we said that was 4 months. Okay. So that is your two calculations for the general borrowings. Does that make more sense now? Do you guys understand that? Okay, so that calculation is correct. That MC below you just typed, that is the correct calculation. Okay, any questions on that before we move on to the general or to the specific loan? Okay, then with a specific loan, the way that it works is that a specific loan, you don't need to worry about the capitalization rate. You don't have to worry about the expenditure or anything like that. You just need to look out and work out what is the interest on that specific loan. And it has to be for during the time where it's used for that project. Okay. So if we go to the question again, remember this was my specific loan, the 2 million rand. So we need to work out the interest on that loan. So that's what we're going to do. And they say that the interest rate on that loan is 9%. Okay. So we're going to take that 2 million rand. Let me see if I can write it here. So this is specific. Okay, it's going to be the 2 million multiplied by the interest rate. And how many months did I use that loan for the project? Okay, that's correct. 1 month. Why are they saying 1 month? Let's go back to the question. Remember that this specific loan was only taken out on this date here, on the 1st of December 2015. The year end is 31st of December 2015. So only for that 1 month was that specific or special loan used for this project. So we're going to multiply this by 1 over 12. Okay, and that will give you 15,000. Okay, is there any question on that? So for the specific loan, it's easier. You don't need to calculate the capitalization rate or worry about the expenditure paid. All you have to do is just work out the interest on that loan and just to determine it will only be capitalized for the period where it's used for that project. Okay, and that is only 1 month, only for the month of December. Okay, so I have a question. Are we not supposed to add 1 million to the 300,000? Oh, are you talking about the expenditure? No. So with the expenditure, you would do them separately. Okay, you don't add them. Okay, so on 31st of March is when you pay 300,000. So you will use 300,000 from that funds. And on the 31st of July, you use a further 1 million from that funds. Okay, so we don't add them because we're working it out separately. So you see the 300,000, we're working it out for 8 months. Okay, which is from the 31st of March until the 1st of December. Okay, and the other one, we're working it out from 31st of July until the 1st of December. So we're still taking into account the full months. And if we add them, that means we would be counting for the interest twice, if that makes sense. Okay, so you do them separately, but you'll still count until the 1st of December and not until the next date of payment. Okay, does that answer the question? Are there any other questions? Okay, so remember that we count in from the 1st of April to the 1st of December. So count again, it would be April, May, June, July, August, September, October, November. So we don't count December because it's the 1st of December where it's taken out from this project. Okay, so we stop actually on the end of November. Okay, I'm going to put up the solution now so you will be able to see the final answer. Yes, so the specific loan, the interest on the specific loan is also capitalized. Okay, so that's what I was saying at the beginning. We need to determine for each loan how much of interest should be capitalized. Okay, so interest is capitalized on the general loans and the specific loans. So 1.2 basically is only for the general loans, while 1.3 is for the specific and the general loans. Are there any other questions before I take this down and go to the solution? Okay, so I'm gonna share the solution. Okay, so this is the solution. Okay, remember I said 1.1 was just, yes,
Hello.
yes, I can hear you.
Yeah, ma'am. I have a question here.
Okay.
So let's start from the slide. When you are obtaining the funds to use in the construction, those funds qualify as a specific name.
Yeah.
So my question is, why are we using uh, uh, 5 mi 5 million, the one of loan, and 5 million of overdraft as a general borrowings, because they qualify as a specific?
No, so your understanding is incorrect. So if you are obtaining the loans specifically only to use for that project, it is known as specific. But if you are
Yes.
using loans for that and other things, then it is general. Okay, so in this question, yeah, I'm going to go back to the question. Um, okay, they say that the construction will be financed with a general 13% loan obtained from finance bank and a bank overdraft of 5 million. So they're telling us that it is general, and if that is not enough evidence for you, then it's also saying that the general borrowings, so those two loans, the 13% loan and the bank overdraft, they were then taken out, the general borrowings have been withdrawn from the project, which means that it's not only used for this project, it's also used for other operations as they state here. You see that?
So yeah, I didn't see
Okay.
the word general now.
Okay. So even if it's the general was not, you missed the general, this here is the biggest clue here, or the biggest way to determine that it was withdrawn from the project and used for other operations. So the moment it's used for other things, it qualifies as general.
Okay, I understand. Thank you.
Okay, no problem. Um, okay, I'm gonna go back to the solution now. Okay, so 1.1 I said was a theory question. So basically this comes from your slides. It says that capitalization of borrowing costs may not be suspended if, like we said, there's a temporary delay, okay, or if the delay is due to technical or admin work. So those are the keywords we look out for when we mark in. Okay, if you mention something about a temporary delay, or if it's a technical or admin work, you would get the marks. Okay. And then 1.2 is to calculate the capitalization rate. So as we said, we want to first calculate the interest for both those. So these are the two general loans. Okay, we're going to say the 5 million times the 13%. So this was the one general loan, and then this was the overdraft, 5 million times 15%. That's the interest for the two loans. We add them together, and then we see the total borrowings are the 5 million and 5 million. We take the interest divided by the total borrowings of 10 million, multiplied by 100, and that gives you the 14% capitalization rate. Any questions? Okay, then 1.3 is to calculate how much of interest should be capitalized. So we started off with the general borrowings, and this was where we had our timeline and we looked at the expenditure. So the first payment was the 300,000. Multiply that by the capitalization rate which we calculated, and then we multiplied by the 8/12, which was from the 31st of March until the 1st of December, and that's how we got 8 months. Then we said the next payment was the 1 million. Multiply again by the capitalization rate, and then we multiply by the number of months, which is from the 31st of July until the 1st of December, and that gives us 4 months. Okay, and then with the specific loan, okay, so the question is, why is it the 1st of December? Let's go back to the question. Okay, so if we read the question, okay, it said that on the 1st of December 2015, the company decided to take out that specific loan, but it also decided to withdraw the general borrowings from this project. Okay, so that's why we stop at on the 1st of December, because it's incorrect for us to capitalize if we're no longer using those two general loans for this project. Okay, if we didn't take out those loans from the project, then we would go until the year end. But because the fact is that we withdrew these loans from the project, then we need to stop on that date. It's incorrect to capitalize if the loans are no longer used for that project. Then we are no longer meeting the requirements of capitalizing. Does that answer the question? No. Okay, so the question is, another question, can we always assume that the bank overdraft is a general borrowing? No, you cannot assume that. Okay, and as also mentioned in the slides, okay, for a general or a bank overdraft, you need to go through the same questions that you ask for any loan. You need to ask, is that loan or that overdraft only used for this project? Then it would qualify as specific. But if the overdraft is used for the project and for other things, then it would be general. So you can't just assume that a bank overdraft is general borrowing. Sometimes a bank overdraft can also be specific borrowing. So you need to go back and ask yourself, what are those loans used for? Is it specifically only for the project? It would be specific. If it is for the project and other things, it would be general. Okay, any other questions? I'm gonna go back to the solution just to do that last part. Okay, so okay, for the last part, for a specific borrowing, remember we said we don't have to worry about the expenditure or the capitalization rate or anything like that. The moment you determine that the loan is a specific loan, all you need to do is just calculate the interest for the months that it's used in that project. And in this case here, the 2 million rand was a specific loan. We multiply by the rate that is given to us, the interest rate, and then we multiply by 1 month. The 1 month is because we only took out that specific loan on the 1st of December, and our year end is 31st of December. Okay, so that means we're only going to capitalize interest for the 1 month. Okay. And then you will add all of those together, and that would be the total interest that will be capitalized. Okay, then the question is, if there was no hint of general in the two loans, would we still say that the first two loans are general borrowings? Yes, so if they didn't say to you that I explained just now, going back to the question. Okay, so let's say in the question, they didn't mention this year that it was a general 13% loan. How would you still know that if it's general or specific? This sentence here tells us that they say that these borrowings have been withdrawn from this project and used for other operations. The moment it is used for other operations, that is a big clue to you that it is general. Okay, so the moment they say it's used for something else, it is general. Does that answer your question? Okay, are there any other questions on the borrowing cost practical question? Okay, so that is borrowing cost. Okay, remember what I said to you guys earlier, that you need to understand or firstly determine in the question which loans are specific and which ones are general. That's going to save you a lot of time, and you're going to be able to know what you need to do, because there's different things you do for general and specific. So always in the question, first determine is the loan specific or general, and you need to do it for each and every loan. Okay, you need to determine, is it a general loan or is it a specific loan? Okay, so then thank you guys. If there's no other questions, that is the practical for today. I will upload the recording, and the solution will also be on Ulink. You can use that to prepare for your test next week, Wednesday. Okay, have a good evening and all the best with your test. I really hope that you guys perform well in this test. There is a tutorial, so there was one tutorial this morning, and I think that there's one this evening. I'm not exactly sure the times, but there is. It's at 6 o'clock, I think. Yeah.